record this. All right, so now in this second part of chapter 3, we're going to talk about riders. The first rider we're going to talk about is the waiver of premium. The waiver of premium, when something waived, that's mean they don't have to do it. So now what happened is sometimes people become disabled. So now if they become disabled, so the company gonna waive the premium if the insured become totally disabled. Now it's not you gonna say you're disabled, doctor gonna have to say that you're disabled. But you have to wait, there's a waiting period. 6 months you have to wait before that can happen. 6 months. Now let's say you disabled, and then well you're gonna pay the policy for 6 months. If they really see you are actually disabled for real, the company gonna refund you all this 6 months that you pay. That's why they say they give you a waiting period for 6 months. And this also expires at age 60 to 65. So if you don't have this after that age, you're gonna expire because Social Security gonna kick in. That's why it's expired at that time anyway. The next disability rider you can have is a disability now with income. This is where somebody can have a policy. If they cannot pay, they become this because of disability, they cannot work, they permanently become disabled. Now, they're also going to receive a paycheck as well. This is similar to a waiver of premium, except this one have a monthly income attached to it. Now, this is not that often done, but sometimes you can find a company that might do something like this. Usually, they give them a small percentage of the face value of the policy. That's what they're giving them. Okay? So there has a waiting period before the beneficiary begin, before the waiting period begin. So it's still like they're going to have to wait for that waiting period. Most likely, you might think it's the same 6 months. So they can receive it's in a paycheck, but it's going to come from the face amount. Any question about the disability waiver premium? Those are straightforward stuff. Go ahead. Carson, you have a question? Go ahead. What is it?
No, I say I'm okay.
Okay, so now you know if somebody disabled in disability, you know what they should put in there. Now, what about the payer benefit rider? What is this one for? You know how, imagine you have a lot of kids into a policy and they're on their age, they cannot work. So think about it. If the person who's paying the policy pass away, do you expect the child to go get a job at 5 years old, 16 years old or whatever? You think they're gonna be able to go get a job to pay the policy? No, there's no way. So if the payer pass away, so they put this rider in there to protect the minor children, those kids, in case, okay, if the payer, which is the policy owner, they put in that just in case the parent or the guardian become disabled, not the kids, the parents, the person who's paying the policy, if they become disabled or if they die. So if you have kids into your policy and you pass away, so that's when your kids don't have to pay the policy until age 21 or 25.
25.
Depending on which company it is. Okay, some company might give you 21, some state might say 21, some state probably 25. So until they reach that age, they don't have to pay that policy until that age. That's why you put it. So the payer benefit rider, it doesn't increase the face amount. Put a note on that. Payer benefit rider do not increase the face amount. Because they might ask you some test questions, say, which of the following rider will increase the face amount? This is not one. This is only there to protect the kids, minor children. Okay? Kids that's those are the ones that they protected. So that's the reason. And this heavily tested. Now, accelerated death benefit rider, I'm not sure it can go to the exam or not. Sometimes it does. When they're talking about accelerate mean, make it come faster. But what they're going to make come faster? The death benefits. So that in order for them to do that, you have to be terminal ill. If you are terminal ill, the insured must be suffer from a terminal illness. Okay, something like that. They're going to die in the next year or so, like a cancer. Now, they may not say somebody's going to die in a year or so, but you have to read between the lines to know what terminal illness means. Usually they use cancer. That's what they're going to use. Because they know when somebody has cancer, they're going to die. It's a matter of time. They will die. No joke. That's a terminal illness. So if that happens, the person can use the accelerated death benefits while they're living. They can take money from that policy. Now, will we reduce the death benefits by the amount paid to the accident benefit. So whatever you take, let's say if you take, you have $100,000 policy, and you take like 50,000 out of it. Okay, your new fee is gonna be like 50,000 because you already take some. Okay. Question on that? If not, we're gonna move along. Long-term care.
Répondre pour moi, s'il te plaît.
So the accident death benefit,
Mhm.
they use this rider, okay, just in case somebody terminal ill, somebody who's ever suffered cancer, or maybe they say they're gonna die in the next year or so. In the next 1 year, after like in 12 months, within 12 months, that person gonna die, or 6 months, that person gonna die. You have only 6 months to live. Have you ever heard they say that to people?
Oui.
So once they say that to them, that's when if they have a policy, they can do accelerated death benefits. So that's when they can take some of that money before they die. That's what that is.
Okay.
Long-term care. Well, long-term care pay monthly income to help cover costs of healthcare for people who's in nursing home. Okay, because there's a lot of tigramun, we tell them. So sometimes they you know, that when they get older, and this policy you can add it in there, so to protect them. That's a long-term care to take care of them until they die. Because people that do CNA, you know what I'm talking about, because that's how they can find some of that money to pay you guys as well, because they got money coming from long-term care as well. There's other option they use, but that's one thing they can use. Another rider you can find, other insured rider. That's a term rider. Other insured mean is a term insurance. Okay, they added to a policy to cover a spouse, children, or any other person. That's called other insured rider. When you see the word term rider, it's just like say it's a term insurance. So somebody can have a whole life and they put this on it. That would be a term insurance and side that the whole life. So it add additional temporary protection or coverage at a reduced cost to the primary beneficiary. Okay, to a whole life policy or to a term policy. Because you can have a term, you can also put your spouse on it as well. Okay, or the insured rider. So now, accidental death rider or accidental death and dismemberment, what we call AD&D. This is somebody now, in case that person, you know, have an accident, usually they can pay double or triple indemnity. So when you see this in the exam, just find out if the person will be able to get double. That's when if the person covered for $100,000, they can pay them $200,000. If they cover for $100,000 and they have triple indemnity, that's mean they're gonna get 3 times. That'll be $300,000. Okay, but they have to die by accident, and the death must be happen 30 days from the accident. After 30 days, good luck. Good luck. They ain't gonna pay you double or triple. And the amount paid in the accident death called the principal amount of the face amount. Okay, and they pay that. They could pay that into a lump sum called capital sum. Okay, for the loss of a body part. Maybe the person lose a hand, an eyes, or maybe an arm, or maybe a leg. That's where the dismemberment come. The capital sum is usually half of the amount paid to accident death rider. So that's just so you know, just what you need to know on this is just like when you see the accident death rider or into the policy, just remember it's double or triple indemnity. But make sure the accident cannot be your fault. If it is your fault, they're gonna refund the premium. They're gonna refund the premium if it is your fault. Question on that, but it's only accident only. Like a head collision. 2 car crash and the person die. That's it. But it cannot be your fault. If it is your fault, good luck. Good luck with that one. Another one that's heavily tested is this one right here. Is what we call guarantee insurability rider. That's allow for a purchase of an additional insurance at a specified feature, date, or event without evidence of insurability. That's somebody who want to get more coverage, but at the same time, they don't have enough money to pay right now. So they purchase this rider. Remember, when you get this rider, you customize it. So that's mean I need to buy more insurance later on. So that's mean they don't have to prove that they're in good health. Automatic, they have this rider, they're gonna put additional coverage. Okay, but it's gonna be based off their age at that time. It's usually expired at age 40. Now, this is what you need to know about this. If somebody have this option, you cannot, put it because if you buy a new house, that's not the reason to purchase this. But if you're gonna get married, you can use that guarantee insurability rider because your family gonna become bigger. Okay. Let's say that if you're gonna have kids, you can add that option in there because your family is bigger, then you need more protection, but not because you want to buy a house. Because they might say all of the following are part of the guarantee insurability rider except somebody who's buying a home. Or they might say which of the following is part of the guarantee insurability rider. Okay, they can tell you that as well. Any of this thing here. Now, usually they might say, well, this rider available to everybody is not available to everybody. Because once you pass 40, you cannot have that option. That's why you can say this rider is not available to everybody. If there's an except question, that's one of them. Is not available to everyone. It's only available to people under the age of 40. Question on that, this is heavily tested. Make sure you know that. The last one thing is return of premium rider. Just like you say, they're gonna return the premium. Is a policy they say, you know what? If you buy this policy, we're gonna return the premium. That's what that is. But if you die, they're not gonna return the premium plus your death benefits. No, that ain't gonna happen. That's not going to happen. If you don't die during a certain period of time, they're gonna return the premium that you pay. But if you die, they pay death benefits. That's what they're gonna pay. But they won't give you both. And this the expire it's 60. At age 60, that's expired. Okay, that was it for the riders. Any question on that?